It is clear that global power markets are changing dramatically. Deep cuts to carbon emissions are needed, but all the governments are still facing energy transition, energy affordability, and energy security, the very typical trilemma. All the regions are facing different challenges, but they are all interlinked together. We're going to continue to see a very strong demand growth in Asia Pacific. In our forecast, in the next decade, almost 75% of demand growth will happen in Asia Pacific. This will require around 4 trillion US dollar investment into power sector in the region. A third of this will be spending on solar capacity. So we forecast from now to 2050, solar capacity will reach to about 7 terawatt. During the same period, the wind install capacity will reach about 3 terawatt. Energy storage sector is another booming sector in the region, and we do see around 14% of the investment will be spending on energy storage from now to 2034. So that will come up to about 125 gigawatt total install capacity for energy storage in the region. So it's higher than coal, gas, and nuclear combined. Coal supply is still declining. We're going to see a continuous decline of the generation share from coal from 2024, 53% down to about 10% by 2050. In the same period, the total generation from the gas-fired power will double. So another thing is about the emission. So we're going to see a continuous decline of carbon emission from power sector. It's about a 56% drop between now and 2050. So another trend along with the renewable penetration is that we do forecast there'll be more spending on transmission and distribution sector. The investment would increase by 20% by 2050. And in the same period, we forecast the solar curtailment in the region would jump from 2% today to about 7% by 2050.
In the US and Canada, it is difficult to overlook the impact of data centers on power demand growth. Huge investment in AI and cloud computing are driving demand in specific areas, such as Northern Virginia. Combined with electrification and manufacturing onshoring, this will boost power demand by 2.9% a year over the next decade. Yet, meeting this demand will not be straightforward because of grid constraints. I've been tracking the impact of this demand and the phase out of US federal renewable energy tax credits on the gas sector. We forecast that they will result in 54 gigawatts new gas generation by 2030. Coupled with new LNG projects, this will drive benchmark Henry Hub gas prices up to $5.2 per million British thermal units by 2035 and $8.31 per million in 2060. Once the renewable energy costs are thrown into the mix, this will buoy demand for solar, wind, and storage. Declining costs and rising energy market revenues will improve margins, so it strikes me that renewable energy credit prices are likely to fall. Over the border in Canada, investment tax credits will remain in place for renewable energy projects for the next decade. Demand growth will be lower than in the US at 1.6% a year, but it is a challenge. Grid upgrades are needed here too to keep up with demand. Taken together, US and Canadian power sector carbon emissions will increase by 7% over the next decade, but fall by 38% between now and 2060 on the back of the renewables revolution.
On the other side of the Atlantic, European power demand is set for growth following decades of load stagnation. After 3 years of consecutive demand expansion, we expect an acceleration towards the end of the decade, with load growing 23% by 2030. Transition policies supporting the electrification of transport and heating, combined with data center buildout and green hydrogen production, underpin this strong growth, which is necessary to incorporate new renewable generation. Still, global geopolitical instability on the heels of world trade tensions creates macroeconomic headwinds that temper demand potential. Here too, renewables integration and grid balancing will be a challenge. Was last year's Iberian blackout a one-off event or a sign of things to come? Increasing volumes of variable supply from wind and solar have forced Europe's TSOs to adapt and enact new operating standards. Transmission investment, backed by the EU grid package and capacity markets, will be increasingly critical for European power markets. The expansion of battery storage, which will reach 230 gigawatts of capacity by 2035, will be decisive in limiting renewables curtailment as negative priced hours have proliferated in recent years. The second major supply shock of the 2020s will motivate policymakers to double down on efforts to move away from gas-fired capacity in Europe, despite its critical role in balancing markets. How can this be offset? The outlook for offshore wind has been undermined by cost increases that have led to tendering hiccups. Although I expect more support for nuclear asset operational extensions here in Europe, new projects will need to be delivered on time and on budget before nuclear can be relied upon as a viable option for widespread new capacity build-out. Additional LNG availability in the coming years will drive down fuel prices along with power pricing.
Latin America's story is one of clean power making huge advances over the next decade. Renewables, including large hydro, will account for 87% of Brazil's total generation by 2035, with 25 gigawatts coming from utility solar, 33 gigawatts coming from distributed solar, and 22 gigawatts coming from wind power added in just a decade. This renewable development will happen at the same time as total Brazilian power demand increases by 3.4% a year over the next decade. The picture in the rest of the continent is pretty similar, with solar and onshore wind providing 54% of Chile's total capacity by 2035 and 56% of Argentina's. Data center development will help drive up this power demand in the region. This sector will account for 90% of Brazil's total load by 2035, with 3% in Argentina and 4% in Chile. Further north, Mexico will continue to look for more gas-fired capacity, but it too will ramp up its renewables investments. Mexico's electric sector development plan includes a 30% energy storage mandate for new renewable projects. This should give the battery storage sector a real shot in the arm. Wood Mackenzie has been closely watching Mexico and Argentina's plans for higher gas production. Argentina is currently a seasonal LNG importer, but new investments in shale gas and pipelines will turn the country into a regional liquefied gas exporter by 2035. It seems likely that increased regional supplies will make it cheaper for Brazil to import gas. This will underpin a rise in Brazilian gas-fired capacity from 25 gigawatts now to 33 gigawatts by 2035, as new peaking units are completed. What we are learning here offers real lessons for the global energy transition.